Two investors, two different strategies for a $1 million prize pool. This is the story of the biggest wager in investing history. The year is 2007, and Warren Buffett, one of the world's most successful investors, has just placed an open challenge to anyone brave enough to take him on. Buffett made a prediction that over a 10-year period between January 1st, 2008 and December 31st, 2017, an S&P 500 index fund would outperform any selection of hedge funds. A hedge fund manager by the name of Ted Seides was the only man to take Buffett up on his wager, and so a $1 million bet was born. Buffett believed that hedge funds were incapable of providing better returns to investors over the long term, after fees, costs, and expenses had been accounted for. Hedge funds, whose modus operandi is to provide above average investment returns to wealthy investors, charge exorbitant fees for doing so, under what's known as the 2 and 20 system. The 2 and 20 system operates as follows. Say you invest $1 million in a hedge fund. 2% of that $1 million, which is $20,000, will go straight to the hedge fund manager for the trouble of managing your money. Then say your investment grows in value from $1 million to $1.1 million. The hedge fund will take another 20% of the gains made as compensation. So a gain of $100,000 will leave you with only $80,000 after the hedge fund takes its cut. This has allowed many hedge fund managers to become very wealthy at the expense of their clients. Compare this to the fees charged by the fund which Buffett chose as his horse. The Vanguard 500 index fund charges a flat 0.04% fee to investors, meaning a $1 million investment in this fund would only garner a fee of $400, with no fee charged on the gains made by investors. Buffett's argument was simple. Wealthy investors would be better off putting their money into low-cost index funds and staying away from hedge funds. Ted Seides disagreed. Ted chose 5 fund of funds to represent his side of the bet. Each of Ted's funds used their investors' money to invest in lots of different hedge funds. This was done so that the overall performance of Ted's 5 funds after 10 years would not be distorted by the over or underperformance of any one given hedge fund. Ted was trying to prove that hedge funds overall perform better than the S&P 500, even after fees are accounted for. The scene was set and the terms were simple. Whoever delivers the best investment returns net of fees, costs, and expenses after 10 years wins. The winner of this wager would walk away with $1 million to be donated to a charitable organization of their choice. Would it be Warren Buffett and his S&P 500 index fund, or would it be Ted Seides and his 5 fund of hedge funds? Let's take a look at what happened. By the end of the first year, in 2008, the world was in the midst of a global recession. Michael Burry's predictions about the US housing bubble had come to fruition, and the global economy was now reeling from its effects. Naturally, the markets did not take too kindly to this, and Buffett's horse was slow out of the traps. In its first year, Buffett's S&P 500 index fund lost 37% of its value, and to make matters worse, all 5 of Ted's hedge funds performed better than the index, despite each fund losing their investors' money. This wasn't all too surprising. Hedge funds, by design, try to provide their investors with returns that aren't correlated with the broader market. In other words, when you invest in a hedge fund, you're expecting investment returns that aren't tied to what's going on with the likes of the S&P 500. So if you were a hedge fund investor in 2008, while you might not have been expecting positive returns, you would definitely be expecting better returns than the S&P 500. One of the more well-known tactics that hedge funds use to make money, especially when everyone else is losing money, is what's known as shorting. Now, when you short something, you're making a bet that the price of that something will go down in the future. In the case of shorting stocks, a hedge fund will borrow millions of dollars worth of whatever stock it is they're looking to short, and they'll sell that borrowed stock there and then on the open market. Now, because the stock is borrowed, the hedge fund will need to return it at some point in the future, and to do that, they will need to repurchase the stock on the open market. The hedge fund is betting that they'll be able to buy the stock back at a cheaper price in the future than what they sold it for today, so that when they return the stock, they'll simply pocket the difference as profit. Hedge funds shorting stocks received an insane amount of media attention at the beginning of 2021 with GameStop. You might remember GameStop stock skyrocketing in price and it being mentioned in nearly every news outlet around the world. That was because regular investors figured out that hedge funds had massive short positions on GameStop stock, i.e. the hedge funds were betting on the price of GameStop going down. So, in an act of defiance against the hedge funds, a Reddit community known as Wall Street Bets started encouraging everyone and anyone to buy GameStop stock. That forced the price of the stock upwards, which caused the hedge funds to lose billions in what's known as a short squeeze. This was a day David versus Goliath moment for the investing world. David being this Reddit community of average people with average jobs, and Goliath being these hedge funds who represent the wealthiest individuals in our society. And that's why I find this bet between Buffett and Saidi's so interesting, because it's almost like Buffett's side of the bet represents David and Saidi's represents Goliath. 08 went to Goliath, but let's see what happened next. In both 2009 and 2010, Buffett's S&P index fund outperformed all 5 of Ted's hedge funds, returning a whopping 26.6% and 15.1% respectively. Meaning, in those 2 years, the millionaires and billionaires who are attracted to the exclusivity of hedge funds would have been better off investing in the S&P 500, an investment designed for the common man. Understand that behind these hedge funds, which Ted's 5 funds are investing into, are investment professionals who are being paid very well to actively trade stocks and other assets on behalf of their clients. Meanwhile, the S&P index fund is on autopilot. This fund simply adjusts how much stock it owns in each of the 500 largest companies in the US, in line with the weightings set out by the S&P 500 index. There is no investing guru at the wheel. The investments are determined by the index, and that's why it's so cheap. In the 7 years between 2011 and 2017, Buffett's index fund outperformed all 5 of Ted's hedge funds on 4 separate occasions, which is truly phenomenal. And even in 2 of those years where Buffett's fund was bested by one of Ted's, Buffett's fund still outperformed 4 out of the 5 hedge funds. So in the 10-year period which this bet ran for, there was really only 2 years where you could actually consider Buffett's fund to have lost. But it was the total returns over the 10 years which would determine the winner of the $1 million. Ted's first fund had a final gain of 21.7% and an annual average gain of 2%. His second fund had a final gain of 42.3% and an annual average gain of 3.6%. His third and best performing fund had a final gain of 87.7% and an annual average gain of 6.5%. His fourth and worst performing fund had a final gain of a measly 2.8% and an annual average gain of 0.3%. And his fifth and final fund had a final gain of 27% and an annual average gain of 2.4%. So, the fund to beat was Ted's third fund, which returned 87.7% to investors after all fees, costs and expenses had been accounted for. As you might have already guessed, Buffett's S&P 500 index fund blew this out of the water, with a final gain of 125.8% and an annual average gain of 8.5%. Buffett won the bet, and his winnings of $1 million and then some went to a charity called Girls Incorporated of Omaha. So what are the lessons here? Well, first off, between 08 and 2017, hedge fund investors would have been better off investing in a simple yet effective S&P 500 index fund. As Buffett pointed out in a 2016 letter to shareholders, wealthy individuals have a tendency to believe that their money should buy them something superior compared to what the masses receive. For that reason, many of them struggle to subscribe to the idea that the common man's S&P 500 index fund can deliver better returns than the prestigious and exclusive hedge funds to which they have access. That ideology has and will continue to cost the wealthiest in our society billions of dollars. Not that I feel bad for them. And the root cause of the underperformance of hedge funds? Fees. Buffett estimated that roughly 60% of all gains achieved by Ted's 5 hedge funds were paid to the hedge fund managers, not the investors. And even when the hedge funds were losing money, the hedge fund managers were making money. Buffett's fund, on the other hand, a flat 0.04% annual fee, end of story. And that's inclusive of all fund costs and expenses. It cannot be emphasized enough how important it is to be cost conscious with your investments, and not even just with investing, but in every aspect of your spending. If you were to invest $5,000 each year for the next 40 years at an annual average return of 8.5%, which is what Buffett's fund achieved, and you paid fees of 0.04%, which is the same as Buffett's, you'd walk away with $1.7 million after paying fees of 19 grand. But if those fees were increased to just 2%, all of a sudden you're only walking away with under $1 million, and you're paying over 730 grand in fees. When you consider that the hedge funds were taking 20% of all gains as fees, in addition to an annual charge of 2%, you can start to see why Buffett won the bet. Again, in the words of Buffett, performance comes, performance goes, but fees never falter. Of course, not every hedge fund investor in the world underperformed the S&P 500 between 08 and 2017. 2017. But that wasn't the point of the bet. The point was that hedge funds on average will provide worse net returns than the S&P 500 over the long term. Ted's 5 funds were invested in over 200 different hedge funds, and some of those funds were bound to have beaten the S&P 500 after fees, costs and expenses. But the fact is that it's just not possible to know which hedge funds are going to perform best in the future, and the same goes for stocks, ETFs and mutual funds. So saying that some hedge funds outperform the S&P 500 is ultimately an irrelevant conversation, unless you have a crystal ball that lets you look into the future, and if you do, please DM me. There's also an important lesson here around the effectiveness of active versus passive investing strategies. Over the long term, investing into a passively managed investment vehicle like an index fund has been proven to outperform investing in funds which are actively managed by investment professionals. Why fork out high fees for these professionals to manage your money when they don't know and will never know which investments are going to perform best in the future? And it's not just the wealthy who have a tendency to believe that their money is best placed in the hands of investing professionals. Retail investors have pumped billions of dollars into funds managed by the likes of ARK Invest, under the pretense that Cathie Wood and her team have somehow developed the ability to handpick industry leaders of the future. But that hasn't worked out well for those investors to date. I want to conclude this video with a quote from Buffett's 2017 letter to shareholders, and it reads as follows: "Investing is an activity in which consumption today is foregone in an attempt to allow greater consumption at a later date. Risk is the possibility that this objective won't be attained." Now, if we think about this quote in the context of Buffett's bet with Ted Seides, what it proved was that hedge fund investors are taking on needless additional risk. Again, risk being defined as the possibility of not achieving large investment returns in the future. Because these investors were paying ludicrously high fees to their hedge fund managers, they were taking on much more risk. But had they invested in an S&P 500 index fund, that risk would have reduced significantly. And that lesson should be taken on board for any of you who are planning on investing in anything other than low-cost index funds. How much additional risk will that choice bring? And is it really worth it? Just some food for thought. So I really do hope you enjoyed this video. If you did enjoy it and want to see more like it, check out either of the videos popping up on screen now. If you want to become a supporter of the channel, consider subscribing and leaving a like on the video. That's all from me for today, but I'll see you in the next one. Cheers.